Thank you for listening to this online presentation, Agency Valuation Basics. This is a short discussion on insurance agency valuations, covering why you may need one and some things that you may want to understand going into the process. My name is Michael Mensch. I'm a managing partner at Agency Brokerage Consultants and oversee a lot of our valuations and transactions that we work on. And in case you're not viewing this on our website, there's our link for our website. So some more information about Agency Brokerage Consultants. We basically have three areas of services that we provide. Those are on the left, agency valuations. That's for retail and wholesale insurance agencies. Could be in property and casualty, life and health. We've got experience in all those areas. Second category has to do with representing owners in the sale of their insurance agency. And we'll talk about that more in actually one of the other presentations. And the third category is we represent parties that are actively looking to acquire insurance agencies. We will take on engagements where we'll go out and discuss, talk to agency owners, find parties that may be interested in selling and put them together and help complete the transaction. So 3 buckets of services: determining fair market value, helping owners sell their agencies, helping parties go out and acquire independent agencies. Our team are highly trained merger and acquisition professionals. Some of the credentials include Merger and Acquisition Master Intermediary. That's a certification through M&A Source, one of our professional associations. There's only about 150 to maybe 200 in the entire country, and at least half of our team have that certification. Certified Business Intermediaries through the International Business Brokers Association. Both the first two have to do with transaction advisory, and to get those we have to take classes on taxes, tax accounting, contract law, marketing, sales, all those things. Next two have to do with business valuation, so the Certified Valuation Analyst and Certified Appraiser. And then the last credentials on there, securities and real estate brokerage licensing. Many states in the country require somebody who is transacting the sale of a business to either have a real estate broker's license or a securities license, depending on whether it's an asset or stock sale. So, and we also actually have an attorney on our team too. So we've got pretty well experienced, pretty well trained staff of people working in our office. So let's get started here. So agency appraisal basics. So what we're going to talk about first is just an overview of how a business appraisal is done and the purposes of it. So first thing we discuss is some uses for a business appraisal. Number one on there is buy-sell agreements. So that's typically if there is a partnership, there's usually a buy-sell agreement in place where if one partner wanted to get out of the business, there would be a structured purchase price formula that's already in place. But you may need an appraisal just to verify the value for that particular shareholder. Obviously, for M&A transactions, a lot of times the seller wants to know what the value of their agency is before they put it on the market. The buyers may want to know what is a fair value. And then if there's any third-party financing companies or private equity companies involved, a lot of times they'll want a non-partial valuation performed that kind of supports whatever the transaction price is. ESOP is an employee stock option plans. If the company is going to go public, they will need a third-party valuation. Often if there's gift, estate tax, or income taxes, you'll need a third-party valuation performed. Sometimes if the owner's looking to get life insurance, they'll want to know what the value of the company is. And then, of course, the negative ones are divorce, damage cases, shareholder disputes, and if there's a dissolution of a company. So these are all the different reasons why someone would get a business appraisal of their insurance brokerage. We're going to focus on M&A transactions because that's what we really do. And so that's going to be the area of topic. So the first thing about an appraisal is that you need to define the purpose of why you're valuing the company. What's the effective date for a valuation? Often it's the most recent completed fiscal year. Sometimes you may want to go back and determine a value from previous years if there's a tax issue or something like that. What are the ownership characteristics? Who are the shareholders? What type of corporation is? And what's the intended use? Are you valuing it again to sell the company Is it a value for tax purposes? All these different reasons have different intended result in how the valuation plays out. So the purpose and conditions do impact the appraised value, though. If you're selling it versus trying to figure out what the shares are worth, there's going to be a difference in total value. So we have the standards of value. They go by fair market value, investment value, or intrinsic value. Many cases, particularly tax reasons for the valuation, you're looking at what is the fair market value. Investment value, it may be for if it's a strategic acquirer of the business, they want to know what is the value to them specifically. And then intrinsic often has to do with the value of the underlying assets. What's the premise of value? Usually you're looking at a going concern, meaning the business is bought as an operating entity, or you can determine what's the liquidation value, meaning if it's sold in a fire sale, what's the value of, typically that has to do with what's the value of the tangible assets. You have to identify which assets are being valued. So if there's any restrictions on the assets that need to be identified, that could be if a producer owns book of business, or there's any other liens or restrictions against the assets themselves. We have to identify those because they can impact the value. Talk briefly about the difference between small and big businesses. Number one is obviously the legal entity. Most small businesses are either sole proprietorships, LLCs, or S corporations, while most big businesses are usually C corporations. So you need to understand there's different tax structures involved with the different corporations. What's the management structure? A small business, usually the owner is the manager of the business. With a large business, you may have layers of management. What is the owner's involvement in sales? Again, with a small agency, the owner may be the primary producer, versus a bigger commercial agency. There's oftentimes a lot of salespeople. So what you're looking at is who has the relationships with the accounts. Is it the owner or individual salespeople? How is the business identified and perceived by the public? So if it's a small business, usually the owner's name is in the name of the business. Well, actually, it can be true in large companies too, but how you're perceived, or the size of your business also impacts how you're perceived. Some people like to deal with locally owned small businesses. Some prefer to deal with larger corporations. What's the financial stability of the business? So a small business, usually less stable than a large company. You can look at it like you look at aircraft. A small company is like a small aircraft, a little bit ups and downs can make a little bit more turbulence in the business, whereas a large company is like a 747. Turbulence doesn't impact it as much. So it's smaller companies usually more at risk through economic challenges than a big company. What's the quality of the accounting? So is there an internal CFO, or is there once a year accounting done, tax return done? So usually small business, maybe there's QuickBooks used, maybe there's not. A big business, there's probably internal CPAs that run the financials, and so the accounting's a lot cleaner. And then how would the business, if it was sold or transferred, how are you going to transfer that ownership? So what's the internal perpetuation plan? So in a big business, there's usually a lot of shareholders. It's a lot easier. A small business, if it's a single owner, it's going to be a different transition. Okay, so we're talking about an appraisal analysis process. So really, when we do an evaluation, we look at three different things. We look at the financials of the company, and often looking at 3 to 5 years of financial statements, trying to determine the earnings and the revenue history. Look at the book of business itself, again, the same period of time, but what are the risks of the book of business itself? Which carriers is business placed with? What are the products? What are the account sizes? Then look at the operation of the business. We'll go through a series of questions, understanding how the management is run, how the marketing is run, how the business is staffed, all sorts of different questions on the day-to-day operations. So really, a good valuation should look at three aspects: the financials, then the revenue itself based on the book of business, and then how the business runs on a day-to-day basis. So here's a sample of a snapshot of a company that we valued. So what you're looking at are a summary of revenue and earnings over a period of about 4 or 5 years. And so you have 2007 all the way out to 2011. The top line is revenue. Then you have cost of goods, and you have operating expenses. Then you see the first red arrow there is pointing to the net income. So that's the actual net income that was reflected on the financial statement. And as with most businesses, the owner usually is writing off personal expenses. Maybe there was non-recurring expenses in the particular year. So we'll make adjustments to the net income to reflect what we call the discretionary earnings. So we're taking the net income, we're adding to that owner's salary, benefits, any excess taxes or excess wages maybe for family members, any non-cash expenses, that would be depreciation and amortization, any non-recurring expenses, maybe there's a one-time legal fee or something of that nature. So we make all those adjustments and we come up with what we call the discretionary earnings. And then we're looking at what is the adjusted EBITDA. So EBITDA itself stands for earnings before interest, taxes, depreciation, and amortization. And adjusted EBITDA is because most small businesses do not run with clean financials. As I showed before, to get the discretionary earnings, you have to make certain adjustments. So we're adjusting out all the owner's compensation, and then we have to add back in what it would cost to hire somebody to run that business for the owner. So what is the market wage of what that owner does on a day-to-day basis? And that gives us what's called an adjusted EBITDA. So discretionary earnings has to do with single owner operator of the business. Adjusted EBITDA really applies to if that company were bought and someone were hired to run it, what would be the earnings after paying that management expense. And then we also look, depending on the purpose of the valuation, may look at the net cash flow. That's really how much money is available at the end of the year to go to shareholders and be distributed out to shareholders. So we take the net income, subtract off the corporate tax, take off any non-cash expenses again, or add that back. So we're adding back the depreciation and amortization, subtracting out any capital expenditure. So if office equipment were purchased, that would reduce the money that's available for distribution, and then to make an adjustment there for changes in working capital year over year. And so the net cash flow is really how much money is available to shareholders to be distributed at the end of the year. So when we look at a financial statement, we're looking at what is the net income, what is the discretionary earnings for a single owner operator, what is the adjusted EBITDA if a company were to buy that business and hire management, and then what's the net cash flow if there's multiple shareholders, how much money is available at the end of the year. So this gives you an idea of the analysis of a financial statement. We also look at the balance sheet. Depending on the purpose of the valuation, the balance sheet can be important. Generally, what we're looking at is how liquid is the company, and is there enough money there to cover any accounts payable, particularly to insurance companies. So we're looking at the cash, we're looking at the accounts receivable, which is the total current assets, and we look at the accounts payable and other liabilities, total current liabilities, and figure out how liquid that company is. Again, this company you look at sitting on a lot of cash. It's a very stable business. They're prepared for any changes, economic changes, and this is a very liquid business. Okay, that's then we looked at again. We said we look at book of business. So we'll look at the volume of business by the line of business. So here you see a snapshot of some valuation that we did. So breaking it down by commercial property, how much is workers' comp, how much is homeowners, that sort of thing. When that data is available, we like to have that information. We'll look at it by commissions by insurance company or broker to look at the concentration with different companies, different carriers and brokers. We'll look at the volume by the customer, look at how much concentration, how much of the revenue is concentrated with specific customers. So then what we're also looking at is what are changes year to year, what's the relative concentration in different areas, and so that kind of gives us an overview of how this business is running. You know, there are different carriers fluctuating what they're accepting year to year. Is there a lot of business being written with specific clients? How long has that been on the books? But it really gives you an idea of the risk associated with the revenue itself. Okay, so I gave you a picture of how we look at financials in the book of business. Let's talk a little bit about appraisal methodologies. There's really three methods in any type of appraisal. You have one that's based on the assets of the business. It's called the asset method. You have an income method, which is based on the earnings. And then you have the market method, which is based on sale prices of similar assets. So what we're talking about is if you're valuing the business, you value it based on the assets, value it based on the income it produces, and value it based on what similar businesses are selling for in the marketplace. And generally with an insurance agency, you're not using the asset approach, using the income and market approach. So really, as an appraiser, what we do is we'll use maybe 4 to 6 different methods underneath those 3 categories or 2 categories. And the whole purpose is to, using standard business appraisal techniques, come up with a range or a single value. So we use multiple methods to determine a range of value for the company. And then from there, we're looking at other things. The value can be discounted based on a number of factors. One is risk factor. So if there's a concentration with single carrier, there's a concentration with a single account or a single client, that may warrant a discount. We'll discount it based on the working capital requirements, how much money is required to operate that business. So if somebody bought it, what kind of cash would they need to continue running it without any interruptions? If we're valuing the stock, we may discount it based on whether or not we're valuing a controlling interest in the stock. And then if you're valuing stock versus sale of the total assets of the business, you can have to discount it based on the marketability of the assets. So they're just different things that may be used to discount the value based on different risk factors and requirements. So one thing to understand is that a fair market valuation is not necessarily a real market valuation. And let me talk about that and I'll say why. But basically, a fair market valuation for an appraisal purposes assumes a generic buyer of the business. But generally in your industry, you're dealing with strategic buyers, or we call synergistic buyers. Other companies or other agents that have their own agencies, so by buying yours, there's other hidden value to it than your current earnings. Maybe add new carriers, maybe they can reduce costs, that sort of thing. The other reason why a fair market value may not be a real market value is that the fair market value method uses average or textbook multipliers and discounts. So again, if you're looking at the market approach to value, what other insurance brokerages are selling for is multiples of revenue, earnings, that sort of thing. The appraiser could take an average value over a range of different transactions that transpired. And we know no business is average, so they're taking an average and looking at what was the average multiple. And when it comes to the discounts we talked about, they may be taking a textbook discount, such as this factor. Well, the book requires a 30% discount to value because of X, Y, and Z. And the last reason is that fair market value usually is associated with a cash value for the business. And we know when an insurance agency sells 9 times out of 10, it's not sold at 100% cash to the seller. There are usually terms involved. So for those reasons, a fair market valuation of your agency may not always represent a real market value. So the point of me telling you that is, if you're thinking of selling your agency, what you really want to do is hire a company that is involved in the sale of insurance agencies to perform the valuation for you. Because if you go to a consultant or an appraiser, a general business appraiser, they're not going to know things like what is the real market value, what agencies are really selling for, how to get them financed, and what are the factors that affect the value in the real marketplace. So just recommendation, if you're actually preparing to sell your agency, go to an M&A firm and have them help you determine what the real market value is. Okay. In summary, there are many legitimate reasons you might want to get an agency appraisal. Some of those that we discussed included if you're going through a merger or acquisition, if you're selling stock, if you're contemplating an estate plan, or you have tax issues, if you have legal disputes. All those are valid reasons why people get appraisals or valuations done. As we discussed, there's various factors that can influence the appraised value. So one of those is the purpose of the appraisal. Another one is the conditions surrounding it. And then what we didn't discuss are risk factors that are internal to your business. I kind of go through that in a lot more detail in second presentation, Secrets to Maximizing Agency Value. Understand that the process for evaluation should be very thorough. Someone's going to look at financial history. They're going to look at book of business. They're going to want to understand the operations. And that's to your benefit, because the more that they understand your business, the better feel for they're going to have for what the true value is. We talked about how in some of those methods they're using average multipliers. Well, understand that some valuations may use averages, but no business is average. Every two agencies is going to have some differences, so it helps to have a thorough valuation done. Particularly, the last one says here, industry professional. You want to use somebody that is experienced in analyzing financials on insurance agencies, experience in valuations, understands particularly if you're going to plan on selling your agency, knows what the market is like, how the buyers are structuring the purchase prices and offers, where the money is coming from, all those things. So it takes time to put together a valuation on your end and on the evaluator's side. It should be thorough, but it's very good for you. In my other presentation, Maximizing Agency Value, I talk about a lot of different reasons why you may want to seek one out in advance of before you're developing a strategy to either sell your business or transfer it to somebody else. You kind of want to work that out a couple of years in advance. So I encourage you to look through that presentation as well. So thank you. I appreciate you watching this video. Hopefully you found some of this information useful. Please direct any questions or comments to me. There's my email address. You can send me an email. There's my phone number. You call me at the office at any time. Don't worry, I'm not going to charge you for questions. Glad to speak with you, and I appreciate your time in viewing this. Thank you. Take care.